Hey folks, Dan Frio here, the rate update. Today is election day. So I wanted to do a video on what are rates gonna do if Biden gets elected or if Trump gets elected. So don't go away, we'll be right back. What happened during election times, if Republicans got in or Democrats, and kind of take a broader view on really who determines mortgage rates and how they determined anyways. So let's get to it. So I pulled up a ton of articles, and I've been doing this for 33 years. And what I noticed over time is it's basically what's going on in the economy. And that's what's changing or determines the mortgage rates. So, some of the captions that come up: will the election outcome impact record low mortgage rates? Well, here's what's going on right now. MBSs are getting clobbered. 11, I'll take 11, but we're still staying in a kind of a relative consistent line. Here's what's concerning me about this right now. Let's go micro, meaning let's look at right now, and then let's look at what I'm, potentially we're going to see on the outcome. We might not have the outcome for a few days, if not a few weeks. So that being said, MBSs are down 11 right now. What do I mean by MBSs? So let's just look at that real briefly. MBSs, this is what's happening to the price of a bond, okay? What this bond is it's basically the biggest determination or biggest tool or instrument that affects mortgage rates. It's called a mortgage-backed security. It's a bond that trades. This number is what's happening to the price of that bond. In its simplest form, as the price goes down, the rate goes up. As the price goes up, the rate goes down. So we love to see green. There's an inverse relationship on what goes on with the price and the yields of bonds. So the yield of the bond is part of the biggest determinant of what's going on with mortgage rates. That, along with loan level price adjustments. And we'll leave that to a side right now. Today we're going to talk about the election and the results and what's going on. So what we've been seeing is the Federal Reserve is playing a huge role in all of this. And they're saying we want to stabilize the mortgage market because this is one of the biggest pieces of the economy. The troubling spot though is right here. We're dropping today below some resistance levels. Okay, those resistance levels are, let's go through a little economics 101. We got some resistance lines right here. So when you're charting anything, you have resistance lines. We call this in the mortgage industry, and this charting purposes, Fibonacci levels. So these are short-term ceilings and floors. These are long-term ceilings and floors. Okay, that's what these lines mean here. The other lines involved are moving averages. So we have a 100-day, 50-day, 25-day moving average, and that's represented in purple, which is right here, black and brown, and those are basically condensed right in this range here, okay? The concerning part is we're breaking below the condensed 25 and 50-day moving average, and we're starting to approach the 100-day moving average. You can see how we hit that and kind of stopped, hit there kind of and stopped. If we dip below here, the next resistance level is here. And again, as this is going down, the price is going down, rates are going up. So that means the rate today is higher than the rate on this day, which was, let me see if I can factor that in, basically around October 5th. Again, as this goes down, it's the price. As this goes down, rates go up. As this goes up, rates go down. Okay, so let's not confuse you with that. So this is what I do on a daily basis on my website. I explain to people what's going on, what the trends are doing, and then I go through historic news or current news for that day. But what I wanted to discuss right now is historically what rates do during election cycles. This was kind of intriguing. When you go through this, there's not a lot of change. If you look at this all the way back through, there's really not a big or a substantial move in rates from the time that the election, the person was elected in versus the end. So look at this right here. There's really Not much of a change at all. For those that think 3% high, look back here. Look historically. So when you're looking, I get it. You want the lowest possible rate, but if you closed a couple years ago, or say 10 years ago, you're back in this range here. You probably have a 4 or 5% interest rate. There's a lot of people who still have that rate. Okay. The next thing is I want to really talk about what affects or who controls or what instrument controls mortgage rates. It's not the president. It's not Congress or the Federal Reserve. Basically, it's the markets. So why we follow this is the bond market. I track on a daily basis what stocks are doing, what bonds are doing, and then what affects or what are the pieces of the puzzle that make adjustments in there. So here's what I mean. If GDP, meaning our gross domestic product, how much we are producing as a country, if that is cranking, that means the economy is probably booming. Okay, stock market's probably booming. If you're heavily involved in stocks, you're not buying bonds. So in those robust periods of the economy, usually mortgage rates go up. Again, let me explain why. Okay, so let me just make it as simple as I can. Let's say you have two variations of investments, and that's normally what we have. Stocks and bonds. You might say, mutual funds. Well, mutual funds are a cluster or a grouping of stocks, or a grouping of bonds, or a grouping of stocks and bonds combined. So that's that piece of things. And then you have bonds. So if you're a young person in a booming economy and things are going well, your financial advisors or yourself or your wealth manager is going to say, buy stocks, buy stocks, buy stocks. Because companies are doing very well. They're selling a lot of products. Their profits are going up and up and up. And you'll get to participate in that. Okay? Uncertainty. And as you get older, your financial advisor will start saying, you know what, let's start moving some money into secure investments that don't really fluctuate much, and those are bonds. Now, there are some bonds in there that fluctuate a ton. There's junk bonds, high yield, high risk, and so forth. But normally, if you're getting into the bond market, you want stability. You're like, I want a 1% or a 2% return. You might say, Dan, those returns are gone. Well, in some cases they are, in some cases they're not. So that's what we have two investments pieces to go with. Uncertain times, meaning today, the election period. People are like, you know what, I think I want to get in bonds. Where we're seeing a kind of an anomaly today is, bonds are kind of getting clobbered a little bit. Uncertainty, I think a lot of people are just sitting there saying, I'm just going to wait. They're sitting on the sidelines doing nothing. Okay, that's what I think is truly happening today. Tomorrow, the next day, Friday, based on the outcome, you might see some fluctuations in this short term, but I think long term, here's what's going to affect things. Okay, the biggest piece of this puzzle is the economy was booming before the coronavirus, and mortgage rates were, say, 4. Then the coronavirus hit, the pandemic hit. People are losing their jobs. Companies are going out of business. The government's finally stepped in. They're saying, we need to bail out everybody. Then they also went in and said, we're going to start buying mortgage-backed securities, these bonds. As there's more buying in that market, there's a reduction. What they're doing is they're trying to stabilize the supply and demand in the bond market, the mortgage-backed securities, to stabilize mortgage rates. Because right when this hit, mortgage rates spiked. And let me show you kind of what happened not too long ago. If we go back and we look back here and we look 6 months, I think we might have to go further back than that. Look where we were down in here. Let me see if I can year to date. Look at this. This is when we had the start of the pandemic. Look at this. We were all, again, guys, remember, down means mortgage rates are going up. This is how we cratered. And then look where we've come from since then. because the Fed stepped in and said, we're going to start buying and buying and buying and buying to stabilize the markets and really push rates down. That's what's happening. So this election, I don't really feel that it's going to make major changes in what rates are going to do, say, in the next 6 months or so, because we still have the pandemic. We still need stimulus. We still have a lot of people out of work. We have a lot of people they have forbearance on their mortgages. There's a lot of people that are like, I really don't, I'm not looking to buy a house right now because I'm just uncertain. So the uncertainty there isn't going to go away tomorrow. Now, is that going to change in the next 6-8 months? Absolutely. And that's going to be depending on a ton of things. And this pandemic is the thing that's creating the most amount of uncertainty. If we come up with a vaccine, then now we're like, okay, this is basically like, polio was years and years and years ago. Now we have this vaccine and nobody's getting the coronavirus. Well, that pandemic's out. So now we start to recover. The economy recovers. And you're going to see rates, because the economy is recovering, and companies are starting to produce more, and they're starting to sell more, and there's more robustness, if that's a word, in the economy. You're going to see people starting to move out of bonds into the stock market. You're then at the point where the Federal Reserve's not going to have to be involved in this as heavily as they are right now. So you could see a pretty substantial move in mortgage rates in the next year or two. So now the next thing that comes back is you're saying, well, the Federal Reserve stepped in and they said they're not going to change the federal funds rate probably for 2-3 years. One, I really don't pay much attention to that, because if they see inflation really tick up hard next year, that verbiage in there, they're not going to do anything for years, is going to be chucked out the window. So take that with a grain of salt. The next thing is the Federal Reserve. The chairman of the Federal Reserve is appointed by the president. So if we have a presidential change, we could have a change in the Federal Reserve chairman, which then could change policy, and all bets are off. So I don't know if I cleared up things, but short term, I don't really think we're going to see much of a change. Long term, the pandemic, the Federal Reserve chairman, restructuring of the chairman, if that does take place, that and what happens to inflation and how quick the markets recover or our economy recovers, that's what's going to play a key role in all of this. So that being said, if you like this video, please don't forget to give me a thumbs up. Subscribe down below. Hit the bell so every time I do post a video, you get alerted. But if you like what you see and you're like, Dan, I like this, I would like to learn more about this. You're a realtor, you want to learn more about this. You're a mortgage advisor, you want to know more about this. You're a financial planner, a wealth manager. You should know this helps your clients. If you're in the process of a mortgage, I can help you. Because I follow this all day, every day, and this is what I do for a living, and I love it. So if I can be of any help, the best way to reach out to me is just go to therateupdate.com right here. You're going to scroll down, and this gives you my phone number. This is the best 800 number to reach us. All the social media is right here. You can follow us. I'd love to hear from you. Watch a video. This shows you me and my team and basically what we stand for. If you want to get started on an application, all you have to do is hit here, apply now, or hit one of these. These are basically a funnel, basically a questionnaire thing that takes you through the process, lets us know, kind of pick your brain a little bit, want to know what you're thinking and what you're looking to do, and we'll get back with you with a game plan. So that is it for right now. God bless. Go out there and vote if you haven't voted, and I'll see you tomorrow.